Manan, I'm going to move to the next thing with you, and that is a bunch of changes that impact the capital markets. Let me start with what I thought was a positive change. Private placements, the limit under the 1956 Act was 50 people. That was commonly understood. Now that has gone to 200 non-QIB, non-employee investors. And if you look at what or how many people can be allotted those shares in a transfer, it actually amounts to 16,000 people that you can reach via a private placement in a given year. That's definitely good news, isn't it?
Yeah, I mean, I think the number is not what probably they were calculating, because the number sounds much bigger than they probably had in mind.
200 is a big improvement.
200
from 50.
is, I think, more than...
Each of those 200 can transfer it to 20 people every quarter. So that's
right.
16,000
So
people.
I think 200 is not such a relevant number now, given that they have removed QIBs from this.
Yes.
In the real world, in the real capital markets world, I think what the real problem was that QIB transactions were not able to conduct the way they wanted to conduct the sale. In the sense they had in the number of situations they had more than 50 investors lined up, but they could not sell shares to more than 49 investors.
Right.
That number is no longer relevant now. It could be 50, it could be 20.
Yeah,
so that's a positive.
QIBs out, right?
Yeah,
so that's
a huge positive.
That
They don't count
not
QIBs
included
anymore.
QIBs is a plus.
Huge plus.
That even for non-QIB, non-employee investors, they've liberalized the number not from 50 but all the way to 200, indirectly 16,000. Those are positives.
So the indirect number was always any number, right? There was no number of 20 previously about reselling restrictions.
I get it. I'm saying, but they've also thought through that bit. That look,
Sure.
if I allot to you and you sell down, you know, let's also put in a safeguard there. Let it not be that you can sell down to several people, because then I can allot you 1 million shares and you can sell 10,000, you know, in values of 10,000 to hundreds of people, you know. So
I think what is important. I think what is important is there should be none of these rules about 20 reselling restrictions, for example, for a listed company. So if I do a QIP transaction tomorrow, a QIB is able to buy shares, he should be allowed to sell the shares in the market next morning, which SEBI allows him to do. But now he has to make sure that he doesn't sell the shares to more than 20 investors, which is not something a QIB can control.
So all
in
they
the
need
open
to do
market.
is in that the rule that refers to the transfer to 20 in a quarter, not more than 20, they just need to make sure that that excludes QIBs. That's all they need to do.
I would say not only QIBs, but even if a promoter were to purchase shares, for example, under private placement, he should be free to sell those shares when he can to as many people on the market. So any transaction which is on the market should not have a number restriction at all.
I can see that promoter private placement bit being abused, but we won't get into that. That's your broad objection to private placements. Otherwise, you'd say it's a fairly good development, right? It also comes with what I call Sahara proofing, right? There are safeguards.
I won't comment on that, but
50,000 bank account, your name has to be on the form. So they've put in adequate safeguards.
those are the good things, but there are problems again. You know, I think one important problem would be, it's fairly common in India to do a QIP transaction with a preferential allotment to the promoter. It helps probably in bankers selling the transaction, because the promoter comes at the same price or around the same price that the QIBs do. Now, there is a cooling off period between two private placements under the rules.
Right.
So you can't do a QIP and preferential allotment around the same time.
Right.
That's one. Second is, every time you need to do a private placement, you need to go back to the shareholders. SEBI used to allow you a 1-year window to do QIP transactions under one resolution.
Let me move to
One
this.
positive I just wanted to comment: ESOPs today are out of preferential allotment.
Non-employees.
So today, unlisted public companies today are generally hard pressed because the number of employees are more than 49, and they are not able to issue ESOPs of more than 49 because of the preferential allotment. Today, under the Companies Act and rules, they are at par with a rights issue.
Sure.
So both in terms of pricing and the number, that's I think a positive.
Okay. The other 2 points that you wanted to bring up, Manab, is disclosures and prospectuses. You said that they've asked for sources of promoter contribution, and that's going to be impractical. And then when it comes to offers for sale, a couple of things. Interim dividend to be transferred to IPO investors, that's again going to be difficult to do. And expenses, can they be borne by non-offerers or not? Let's start first with disclosures and prospectuses.
In the real sense, promoters' contribution is typically not brought in at the IPO time, because the promoters would be holding more than 20% shares prior to them commencing the IPO activity. A promoter could have bought these shares many decades ago.
Right.
He may not have the records of how he funded the original purchase.
Got it.
Even if he has the records, it may not always be verifiable, and anything that goes in the offer document must be verified.
Okay.
So it will create some problems, challenges for merchant bankers in being able to do diligence on this aspect.
All right. I'm going to move it on to offer for sale. You've said interim dividend to be transferred to IPO investors. How do we identify them?
Yes, the problem really lies in a situation where you have an IPO where there are new shares which are fresh issue shares and offer for sale shares. So the investor does not know what he is getting.
Right.
You don't know who you're transferring shares to. So who do you give dividend to? And you can't give dividend to everybody because the company shares are also issued at this point of time.
Okay, Narayan, I'm going to come to you. Your key issue was to do with managerial remuneration, that is the withdrawing of relaxations that were permitted on managerial remuneration by companies that were making either inadequate or no profit, right?
Yeah.
But if you're not making profit, shouldn't the company law tell you it's not a good idea to pay your...
No, today it's more in terms
AMP?
of level playing field. Today, if you say a standalone company, which is not a subsidiary of a listed company, can go ahead and pay remuneration without any limits, although they have inadequate profits. The MCA had issued 2 circulars in somewhere in 2011, if I'm not mistaken, where they said that A, if you're a professional and you do not hold more than 0.5% of the capital of the company, and even if you have inadequate profits, you can go ahead based on certain conditions and disclosures, you can go ahead and pay the...
Now that has been taken away.
That has been taken away. And the second, if you are a subsidiary of a listed company, there again there was exemptions given, because typically if you say in a big organization it's a talent pool, the talent would be shifted from one place to another depending on where he or she would really be required to go. Today, the MCA circular allows the holdco to take a hit on its they've got a limit of managerial remuneration. If they've got a limit, they can take the hit on its accounts,
Right.
and the subsidiary cash flow will go from the subsidiary. Both these relaxations which was given by MCA
Have been withdrawn.
and corporates have acted upon it.
Okay.
So I'm sure that with MCA would definitely consider bringing it back and the rules.
You're hopeful.
With the rules, yeah.
You're hopeful.
Hopeful.
Okay. The more important issue, and I know that you sounded very agitated when you were talking to me on the phone about this, was the transfer of shares issue, which is that if 7 years of dividend have not been encashed by an investor or shareholder, then the company is obliged to transfer those shares or is required to transfer those shares to the IEPF, which is the Investor Education and Protection Fund. What is your objection to this?
One, it will be against the fundamental principle of right to own property. You can imagine if you are staying in a place or even a bank account which is not operative for 7 years, the only thing which you have to do perhaps to get a KYC done again. But you can't say that if I have a crore of balance in my savings bank, after 7 years I have to claim it from the central government. Or if I'm living in a house, after 7 years I find somebody else staying in my house and I have to claim it back from the central government.
How prevalent a problem is this, where you have, dividend lying untouched or unclaimed for that long a period?
Today, what they have addressed it partially by saying that even if one of the years, if you have, in one of the 7 years, if you have encashed dividend, then you need not transfer it to the
so
IPF.
I'm just thinking, if 7 years somebody has not encashed their dividend, will it be such a big issue if you transfer? I get the principal issue you're talking about, but really if that investor has not come forward to claim his money in 7 years, then it seems unlikely that he's going to come forward to claim it thereafter, or that's a false
you just say, suppose I've got shares of Reliance, and as part of a scheme of arrangement with their debt, I get one share in many of those 4 or 5 companies which they have. I may really not even be bothered to encash a 1 rupee or a 2 rupee dividend which they would be giving. But one fine day I will find my shares, underlying shares, suddenly out of my cupboard or out of my demat account. And even procedurally, if you see the rules, the way they have framed, today they say that the company secretary or any other person can issue duplicate certificate. The shares certificate would actually be in your cupboard. Without your concurrence, I will be issuing a duplicate certificate and transferring it to the government.
That seems illegal.
Similarly, if you have a demat account, how can I just sign on your behalf a DP slip and transfer it?
Okay.